Hello and welcome to Fidelity Connects. I'm Glenn Davidson. Tax season is in full swing and Fidelity is here to help. From key tax changes to new measures that could impact your bottom line, our next guest is here to answer your most pressing tax questions. How will updates to capital gains and corporate class structures impact investors? And what other tax measures should be on your radar before the deadline? Joining me now to unpack all this and more is Fidelity Director of Tax and Retirement Research, Jacqueline Power. Jacqueline, so nice to be here with you in the studio today.
Thanks so much for having me. I'm very excited.
This is your first Fidelity Connect.
It is.
And so it's lovely to have you here. You are well known in the industry. You've been at Fidelity since October of last year. So you should let our viewers know what your background is all about.
Thanks so much. Really happy to be here. You're right, in the industry for about 27 years now. And I was with one firm for all of that time. So started off actually selling group plans. So group RSPs, pensions, that sort of thing. And then moved on to the tax, retirement, and estate planning side about 14 years ago. So love that side of it. And obviously, I'm still very much engaged in it. And it's just so fun because every time there's a new budget, there's new stuff for us to talk about, which is a good thing.
And throughout your career, you've been well connected to the advisor network across the country.
For sure.
And no different now, but you're here. So wonderful to have you here.
Thanks so much.
So we've got a number of topics we can talk about today, but let's start with the capital gains inclusion rate. That's been quite topical over the last couple of years. If you could take us through what's happened and what's going on.
For sure. So this will be a little bit of a lengthy one because I'm going to take us really right through the whole process. So essentially it started about a year ago, and budget of 2024, the federal budget proposed to increase the inclusion rate to 2/3. This was going to be effective June 25th. And for corporations and for trusts, that 2/3 inclusion rate was beginning right at $1. For individuals, we had a bit of a buffer. So the first $250,000 of gains that were realized, we still had that 50% inclusion rate. It was just anything above that was the 2/3. So as you can imagine, lots of people were not happy. A lot of individuals ended up selling items earlier than they otherwise would have.
Last June, that's right.
Right, with the cottages and that sort of thing. And we know a lot of individuals sold at a loss or not as high of a price so that they could end up having that early closing. And now I'm sure they're kicking themselves. Same thing with corporations. We saw a lot of realized gains within the corp. And I think the reason was to take advantage of the 50% inclusion rate. And because that way you're having 50% added to the capital dividend account instead of 1/3. And the reason the CDA is important is because that allows the corporation to pay out capital dividends, which are tax-free dividends. So there was lots of movement happening before June 25th. And then after June 25th, new rules came into effect, but the issue was the legislation never passed. So the Notice of Ways and Means motion passed, but the actual legislation itself did not. Mm-hmm. And the reason why this is an issue is because January of this year, the former Prime Minister, Trudeau, decided to step back, and he also decided to prorogue government. So that created issues because once government's been prorogued, any legislation that hasn't passed is essentially dead. So you've likely, lots of our listeners, or viewers, read those articles saying that the capital gains inclusion rate was dead. At that point in time, it was. But we didn't know what was going to happen when government came back and we had a bit more idea of where we were going forward.
And CRA had been sticking with what had been proposed last year.
And that's exactly what I was going to say. That's where another issue is coming up, is because of the fact that when people were thinking about filing their taxes, CRA is like, nope, we're going with the higher inclusion rate because the Notice of Ways and Means motion has passed. So obviously a lot of Canadians were not happy because they're like, this isn't legislation. It hasn't actually passed. So we shouldn't have to be subjected to that. So then we come to the end of January where the government says, okay, what we're going to do is actually push it off to January 1st of 2026. So any gains realized in 24 or 25 are going to have the 50% inclusion rate. So we were all super excited and thought this was great, but there's another catch. And what it is the fact that all of the financial institutions, all the software companies had built everything based on the higher inclusion rate. So with that being pulled back, changes were made. So essentially, it's really important for advisors to know clients are going to have T3s and T5s that have the period before the 25th of June and then June 24th and after. So they have to know that. Also on Schedule 3, this is now a 5-page document. So whenever somebody...
Which used to be how
I think it was
pages?
about 3.
Okay.
And so now there's 1 page for any gains realized before the 25th, one for any gains realized after the 25th. Yeah, so, and what makes it even more interesting is because it was determined sort of late in the game that they were sticking with the 50% inclusion rate, CRA has now said that anybody who realized a gain in 2024 or received a capital gains distribution on a T3 or a T5 should not file their taxes because they're not ready for them to file them at this point. So to alleviate any concerns that people have, there's no penalties, there's no interest that's going to apply until June 2nd, but we all have to wait until CRA says that they're ready to accept our tax return.
It's not often that CRA says, you know what, don't file your taxes yet.
Exactly right. So it's and now the final sort of good news is this has now been abolished altogether. So Carney's not going forward with it, and the Conservatives have also said if they get into power, they're not going forward with it either. So it was quite an up and down over the year, but yes, that's how it ended.
We have controversies north of the border, just as they do south. Well, let's change gears and go to bare trusts. I know you have a number of things to discuss in that.
Yeah, most definitely. So this is another area where the government kept us on our toes, and that was for taxation years that began in 2023. So essentially, just to take us back and set the stage with respect to this, the government determined they wanted to have a better understanding of what was happening as far as who beneficiaries of trusts were, who the trustees were, that sort of thing. So they requested additional reporting for all trusts, and that ended up lumping in bare trusts as well. So essentially what bare trusts are is generally where you'll see it. There's no official definition, but you'll see it within trust for accounts. Joint accounts where both individuals don't have beneficial ownership of that account. So essentially that ends up creating a lot of individuals who now had this filing requirement. So that filing requirement was due as of December 30th, 2023. That was the effective date. And the reason they chose December 30th is because a lot of trusts have a December 31st year end. This reporting was supposed to be required by the end of March 2024 to report for any 2023 items. Because of all of the confusion with respect to the bare trusts, also what had happened was that in order to file a T3 trust return, you need a trust number. And so all of these Canadians and individuals were going to CRA and asking for this trust number. So CRA was being inundated with those requests. So essentially at the 11th hour in March of 24, they said, okay, this reporting is not required for bare trusts for 2023 or for 2024. And then essentially we'll get back to you and let you know what's happening going forward after that. So then recently we now finally have more direction. So essentially what's going to happen is if the account is $250,000 or less, it's invested in mutual funds, ETFs, GICs, stocks, bonds, that sort of thing, it's excluded from these requirements as far as the bare trust reporting is concerned. So that gets rid of a lot of these ITF interest for account issues that we had. Joint accounts where the child was just put on for ease of administration of the account. If the account meets that criteria under 250, that reporting's not required there either. So good news as far as that's concerned. And this first reporting requirement will be not until March of 2026.
Bare trusts was a new phrase for me. That's why I'm asking you questions and you're not asking me questions. Is an example where a child might have a parent own property so that they could get qualified for a mortgage, but the child actually has the legal ability to control that property. Is that?
That is exactly what it is.
Are they very popular?
At this point, for sure, because so many Canadians, young Canadians, their mortgages are so high, they need their parents to co-sign on these accounts.
And that's the trustee, whereas the beneficiary really controls it.
Exactly, okay. Exactly. So that's where the situation arises. So now under these sort of exemptions that have come in, we've been told that where parents have been put on just to help them get that mortgage, that reporting should not be required there.
Interesting, very interesting. Canadian tax filers must report worldwide income from all sources. How can taxpayers avoid double taxation on foreign income?
Oh, that's a great question. So essentially what happens is whenever we pay tax in a foreign country, if there's withholding tax on something, then essentially that withholding tax will translate into a foreign tax credit that the individual can use on their Canadian tax return to avoid that double taxation. So we would have to have a tax treaty with that country in order for that to be possible. But where we see this most common is with the US. Lots of different, income that can be earned in different places, withholding tax that can apply, and then that's a way of avoiding that double taxation.
So important for the taxpayer to check which countries have a tax treaty with Canada.
Most definitely, and extremely important for the taxpayer to consult their tax preparer. With all of these, these things that I'm talking about today, it is really important just to double check. Everything is very complex, and you want to double check to make sure that, what I'm saying actually applies to their particular situation as well.
Now let's talk about income splitting. What's happening there?
So lots of fun there. We're really limited in Canada as far as income splitting is concerned while we're in our earning years, if you will. So for example, we're not able to gift money to our spouse to invest. If we gift money to our spouse to invest, essentially what happens is any investment income that's generated from that attributes to the spouse that originally gifted that income. So what some people will do is they'll put a spousal loan in place. And then what happens is that the higher income earner is lending money to the lower income earner. And because it's set up as a bona fide loan, there's no attribution that applies in that situation. But interest does need to exchange hands. The CRA asks that the interest be paid from an account that's in the borrower's name only, because if it's a joint account with the lender, CRA doesn't know who's actually paying the interest.
Attribution.
Exactly, right. Exactly. So, so they want to make sure that that's all done. But if they meet the criteria, then in that situation, any investment income that's generated is taxed to the lower individual. Now, this was really popular when the prescribed rate was at 1%. Yes. So now the prescribed rate's up to 4%. So it's not as attractive as it once was. But we're definitely, we assume that this will come back and be an actual attractive option going forward once interest rates go down. So that's one area that you can income split. And
just a question on that, if I could.
Please.
And there's some administrative cautions around that as well. From my understanding, if you miss a payment...
Pardon me, that's exactly what it is. If you miss a payment, then it reverts back to that loan not actually being in place.
Goes right back.
Right back to the beginning. So it's really important to make sure that this is on the up and up. I always recommend that there be a formal loan agreement that's in place. It indicates what the terms of the loan are, what the interest on that loan is, so that if CRA ever comes in and audits them, it's very clear that they're on the up and up.
Great point.
Yeah.
Next topic.
Next topic would be spousal RSPs. A lot of individuals are very familiar with these. So higher income earner contributes to lower income earner spousal RSP. The higher income earner gets the deduction. And then at the time that they retire, hopefully they'll have more even amounts within their RSP instead of having one really high and one really low. But then that takes us to retirement and income splitting we can do at that point. So essentially, we're really limited when we're under 65. So under 65, people are able to split CPP. So if they're not CPP, RPP income. So say they're receiving income from a defined benefit pension plan, that they would be able to split up to 50% with their spouse. It's done right on their tax return, not with the financial institution. Now, if we're looking at over 65, we have many more options. So anything that CRA considers to be eligible pension income can be split up to 50% with a spouse. So that would include RIF income, LIF income, RPP income, even annuity income as well. Now, I've had questions from people saying, oh, I pulled money out of my RSP, I'm 67, can I split that with my spouse? You cannot. It has to be coming from a RIF. So that's really important to know. Another thing is, as with the RPP income, this is just split right on their tax return. It's not done at the financial institution. So essentially what they would do is wait to see, what both of their incomes are and then determine what makes sense. But as I said, a max of 50% can be split. One more area that they can split, which is CPP. So a lot of people don't realize, but we can actually share our CPP credits for the time that we were together. So say there's a couple, they were together 20 years out of their earning years. The credits that were accumulated for both of them during that 20-year period can be split. And then again, the idea is that they'll have more even amounts that they're receiving in retirement.
So they may be disproportionate contributions, but they can be split evenly?
So the credits can be split evenly for the years they were together. So say they were only together for 5 years, then it's only those 5 years of credits that would be split, but it'll help even out the amounts that they receive.
Interesting.
And that's different than the pension income splitting because that one is done with Service Canada. So they would contact Service Canada, they do the calculation and then split it from there.
Okay, good. What are the tax implications if the gift to a spouse, well, this says gift, goes to a TFSA?
So you can gift. So that is one great question because that is one area where we can gift money to our spouse without having attribution apply. So because there's no tax on the TFSA, that's why there's nothing to attribute back to the spouse that gifted that money. So that is one area where that would work.
Great question.
Yeah.
Charitable donations. Some things happened there as we
Yes.
got into the end of the year.
Yes, definitely. So with this one, essentially what happened is, I guess it all goes back to the Canada Post strike. So because charitable organizations heavily rely on donations coming in through the mail and that sort of thing, they found that their charitable donations this year were lower than they had been in previous years. So normally the way that it works with charitable donations is you're able to donate up until December 31st and can use the donation receipt that you get against up to 75% of income from that particular year. Whereas with this, the government has extended that until February 28th. So if any investors had made charitable donations in 2025 up until the 28th of February, they can choose to use that donation to offset for their income in 2024. Now, there are certain donations that don't count. In-kind donations. And I know a lot of investors are making in-kind donations because it is more tax efficient. So those individuals would not be able to use that donation to offset 2024. Also, if individuals are making donations through payroll deduction. So a lot of individuals will have those deductions going right off their pay. That also doesn't count. But if individuals donated cash, then they can choose whether they want to use that in 24 or 25. One thing I would caution is that because this is not what we normally do, individuals next year may forget that they used that receipt already for 24.
Right.
So it's just a matter of encouraging them to make note of it somewhere. And I encourage advisors to make note of it as well, just to remind them next year when they go to file their taxes that they don't use that receipt again.
That could pose some interesting problems.
Yes, it could.
More complications. Let's talk about corporate class. Corporate class is a bit of a big deal at Fidelity, been around and available for a long time and is extremely well used. Could you give us a bit of a history on it at Fidelity and then talk about where it stands today?
Yeah, most definitely. So we're really fortunate here that right from the get-go, the way that we structured things, it was really looking at different types of income and keeping that in mind. Because I think as everybody knows, we're limited in what we can actually flow out of that corporate class structure. So we can't flow out interest income. We can't flow out foreign income as distributions. So it's really important for us to be very cognizant of how much of that is being generated within the structure. So we're the largest corporate class structure in the industry. We have over $70 billion in assets, over 80 funds for individuals to choose from. And that helps with our efficiency. Because we're so large, it allows us to have a large amount of expenses that we can use to offset that interest income, to offset that foreign income. Because if we don't have those expenses, what happens is that income then gets trapped within the structure. And then it becomes taxable within the structure, which isn't as efficient. Now, we've never had a situation where we've had trapped income at this point in time. I can't say that we never will, but at this point in time, we've been very fortunate, and because of the health of our structure, that hasn't been an issue for us.
And that health is economies of scale, as you just mentioned, but it's also asset allocation, isn't it?
Very much so. So we're really conscious of the amount of interest in foreign income that's being generated. We won't have balanced portfolios that have more than a 60-40 split, just because we need to make sure that we limit that interest income.
Perfect.
Yep. So and not everybody is set up that way, and not all structures are created equally.
Some companies in the industry have had to shut their corporate structure. Some have thought that's because of regulatory changes or concerns. That's not the case. Is it fair to say that any that have shut down are because of issues inherent in the companies versus the corporate structure itself?
That is correct. So I think what had happened was, for many years, the government had been attacking corporate class. You know, they stopped allowing the character conversion. They didn't allow us to switch between funds and that sort of thing. And then what the government had done was, in one of the budgets, they indicated that if you shut the structure as a whole, and transfer all of those assets into the trust version of the fund, you can do that on a tax-deferred basis, whereas normally that's a taxable event. So I think when that happened, any structures that were in a taxable position, I think at that point they decided to close it, because they were worried that the government was going to close the structure anyways. But that happened several years ago, and the structure is still very much alive.
Let's talk a little bit about Canadian politics. Could you compare and contrast what Mark Carney and Pierre Poilievre are proposing from a tax structure potential change going forward?
Yeah, so it's really interesting to see. They're doing a lot of very similar things. So as far as Carney is concerned, for the middle class, he says he's going to drop taxes by 1%.
On the lowest tax bracket.
Yes, and then for Poilievre, he's saying for the lowest tax bracket, he's going from 15 down to 12.75.
Sure.
So just over 2.25 that he'll be dropping. So quite similar between the two. Both are dropping the carbon tax, and I think many of us may have noticed that at the pumps yesterday. Yes. that had gone down, and Poilievre is saying that he's going to keep that off as well. And then the other one is GST on new builds. So for Carney, he's saying $1 million. For Poilievre, he's saying 1.3. So very similar between the two of them, and a lot of those platforms are quite similar.
Thank you for that. How do the new AMT rules, alternative minimum tax, impact charitable donations?
Great question. So essentially, any investors who are subjected to AMT, normally when we do an in-kind donation to charity, the capital gains inclusion rate on that is 0%. But when AMT applies, the inclusion rate is 30%. So that's a big difference there.
Earlier in our discussion, you mentioned anything less than $250,000 is exempt from filing if invested in mutual funds. What about savings accounts and GICs? Are there exemptions or caps on these sorts of accounts?
Yep, so $250 for savings and GICs as well.
Great.
Yeah.
Jacqueline, you're a wealth of information. How do our advisor partners access your intellect and talents?
Oh, thank you. So through our sales team. So they would just reach out to their sales team. Their sales team will reach out to our team, and Peter Bowen, Michelle Monroe, and I would be happy to help in any way we can.
What a powerful team. Very nice to speak to you today, Jacqueline, and congratulations, your first Fidelity Connect.
Thank you so much.
Good to see you.
Thanks.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.